Are you interested in investing in a multifamily real estate syndication, but you're not quite sure who gets paid and how they get paid and how all of that stuff works? Well, in this video, I'm going to walk you through how the general partnership or the syndicator earns their keep in the deal. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about how syndicators on the GP side make their money. It's important to understand how both sides of a syndication earn money, and I'll put a link right up here to a video I did explaining all about syndication. But today we're going to be talking about 3 different ways that syndicators or the general partnership earn money in a deal. And the first way, we can break it down into fees. Now, we can have all sorts of different fees, and it's going to really depend upon the syndicator themselves and the property, the project, because every deal is somewhat different. It may require something different or a little bit more finesse in one area, but we're just going to be talking generally today. So let's talk about a couple fees that may get charged or earned by the syndicator. The first fee would be an acquisition fee. What will happen is the general partnership, they'll go out and they'll hunt the deal. They'll hunt the opportunity. They will be writing LOIs, letters of intent. They'll be negotiating offers, doing inspections, putting a whole lot of money and effort into finding the deal for the syndication to take down and acquire. And what happens is whenever the syndication closes on a deal, it's very common for the general partnership to earn an acquisition fee. And this can range from 1 to 3% depending on the situation. Every situation is different, so again, just take this as a generalization. And this really allows the general partnership to recoup those costs that were incurred in hunting the deal, because it's really time intensive and there are quite a few costs involved in that. Another type of fee could be a construction fee, a construction management fee. Maybe the deal requires a very heavy lift in terms of renovations, and the general partnership has brought on somebody specifically to oversee the construction and renovation component. If there's a lot of work to do, it takes a lot of money and time and due diligence to make sure it runs properly. So the GP, the general partnership, may charge a construction fee to oversee that project if it's really heavy duty. Another fee could be a refinance fee. Maybe after the value add strategy has been put into place, it's been a couple of years, the property has appreciated, whether through market appreciation or forced appreciation, and the general partnership feels it's a great time to refinance, pull money out, maybe return it to some of the investors so the investors can receive some of their capital back early. Doing a refinance on a property, again, takes a whole lot of work, and oftentimes in OMs, PPMs, there's going to be a refinance fee worked in. Oftentimes it's charged as a percentage of the dollar volume of the debt being placed on the property, and this really just allows the general partnership to be compensated for the time and the expenses that go into refinancing a multifamily property, because the process is a little bit different than refinancing your home, for example. Again, with all of these fees are all going to be laid out in the deal documentation that you sign when you invest in the deal, so everything's going to be on paper. There will be no surprises, but it's important to understand some types of fees that may be charged. Now, there's many different ways that you can slice and dice fees, and there's other ones I haven't talked about, but generally speaking, these are going to be the main fees you will find besides some others. The second way syndicators make their money is, let's call it the cash flow. What will happen is during the hold period, the property's yielding positive cash flow. So every month or every quarter, depending on how the deal is structured, you as the investor will receive a check. Now, the general partnership, depending on how things are structured, will also receive a check for their share of the cash flow. So let's say, for instance, the split is 70-30, which is a common split in the industry. So that means 70% of the cash flow goes towards the limited partnership, the passive investors, and then 30% would go towards the general partnerships, the GPs, or the syndicators. This is very common. There is something called a preferred return or a pref return. We won't go into that today. That's the subject of for another video, and I've actually done videos on this in the past, so check that out on the channel. This will just complicate things a little bit more than I want to for this video. So we've got the fees that are charged when usually when something happens in the deal, and then we have the cash flow. So this is on a monthly or quarterly basis, and again, this is split. Now every deal will be different depending on the deal itself, the syndicators, that sort of thing, but generally speaking, it's going to be around a 70-30 split. Again, 70% in favor of the limited partnership, the passive investors, then we have the 30% going towards the GPs. The third way is equity. So we've already covered how fees are earned, and usually these are event-specific fees, so something has to happen for these fees to be earned. Then we have the cash flow, which is paid out on a monthly or quarterly basis. And then we have the equity. So let's say we've implemented our value add plan, and I'll put a link right up here to a video I did explaining all about the value add system and the business plan associated with that. So we've forced the appreciation of the property's gone up in value, and now we're able to sell and hit our return targets. So what will happen is the property goes up for sale, we accept the contract, we go through the closing process, and once the property closes, we have a big fat check. And the proceeds of that sale are going to be split almost always according to our cash flow split, let's call it. So it's very similar. So in this case, let's say we have $1 million of proceeds from the sale. So 70% or $700,000 would go towards the LPs. And then we have 30% would go towards the general partnership, the GPs. Now, the thing I always say with syndications and holding real estate in general is the monthly or quarterly cash flow, it's kind of like the breadcrumbs, right? It's small amounts during the hold period, and then you get the full cake, as it were. Let's draw a cake with the candles on top. You get the full cake when you sell. So you get the breadcrumbs in terms of the cash flow, and then you get the big check at the end. Now, this is where both the investors and the syndicators or GPs earn their money. It's a big fat check, and then you can take that and reinvest it in a deal. All in all, I like to simplify things. So obviously there's more complex ways that you can factor things in, but generally speaking, you're going to have your fees on this side, then you have your monthly or quarterly cash flow, then you have the equity, and that's going to be split according to all the syndication documents, but 70-30 is, I guess you could call it, an industry standard. The whole reason we have these splits is to really incentivize the general partnership to do well on the deal, because obviously the more cash flow the property generates on a monthly or a quarterly basis, the more the general partnership is able to earn on it, just like the more the investors are able to earn. And the more we can force the appreciation of the property through the work the general partnership is doing, the more the general partnership can benefit, because they're going to earn more money. Same with the passive investors. So think of it this way. We have the fees. These are really just to compensate for time and expenses, like the acquisition fee, construction management, refinance fee. The real money that is made by the syndicators and also the passive investors is made on the cash flow, yes, but it's really on the sale, upon disposition of the property when you sell and you realize all of your gains there. This is where the money is made, and this is why syndicators work so hard during the hold period, implementing the business plan, making sure we are being compensated when it comes time to sell. This is where the money is made. If you're interested in learning more about multifamily real estate, join our free Facebook group. It's a great bunch of people. I'll put a link right down below this video. And if you are an accredited investor and you want to learn more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.